one of the things that we decided to look at today was, so what if you wanted to just play for a big down move? Okay, using what?
I said okay, yeah.
Yeah, using zero DTEs, play for the big down move. How hard do you think it is?
Oh, I mean, I know how hard it's got to be because you'll go broke before it ever happens. I mean, you can get lucky. Anybody can get lucky. But
we're going to show you some statistics on using zero DT options that are going to show you that if you want to play on a very short-term basis, and short-term is better than long-term, by the way, in this case. And if you want to play on a short-term basis, that you have to be, when you're right, you have to be so right that it's going to be scary. In other words, you can't be like right one out of every 2 times. Like, I mean, I'm sorry, you can't be right. Like when you're right, you have to be
spot on right in a short period of time.
20 times better than when you're wrong.
Okay.
So if you're willing to lose $1 when you're right, you got to make over $20 to at least come out positive. Let's take a look. Mm-hmm. So on Tuesday, that's 2 days ago, the implied volatility priced a 50 basis points, 0.5% move in the SPX for Wednesday, the next day, which was yesterday. Mm-hmm. But the market opened down over 1%. Looking at the massive returns on zero DT puts, because people were talking about this. How often do these moves have to pay out for this trade to be profitable? In other words, if you'd bought puts on Tuesday with the expected move being 0.5%, and the actual move was over 1%, and you just bought puts, you would have cleaned house. You'd made a fortune. Mm-hmm. Okay? How often do you have to do that, Mr. Batista, to make some money?
Well, you just told me it's over 20 times, so I'm going to go.
Let's take a look.
40 times.
50 times, whatever it is. So with most of the out-of-the-money puts in the SPX jumping between 10 and 15 times from yesterday's close, we would need to see a day like this happen roughly 7 to 10% of the time to break even on the trade. So roughly 7 to 10% of the time to break even, we need to see a move of over 2 times what the expected move is in the direction, in this case, in the direction to the downside that we want. That does not seem like it's very easy, does it?
No.
and by the way, that's just on this trade. Let's go to the next slide. So we decided to do a study to look at this in depth. And we looked at the SPX and the VIX since 2000. We separated all the days when the VIX was below 15. We recorded the percent of time, because that's where the VIX was on Tuesday. We recorded the percent of time when the SPX closed lower by 1%, 1.5%, and 2% on a day where the VIX closed at 15 the day before, 15 or lower. All right, so let's look for big moves when the VIX is cheap. That's what we're looking for. Okay. We conducted the same study for all market days since the year 2000. So 23 years worth of research.
It's fair enough subset.
Fair enough subset. Let's go next slide. Despite a 10 to 15 times move in the put options, the market only makes these moves when the VIX is low less than 5% of the time. Less than 5% of the time. So yesterday, the day we saw yesterday had an even lower probability, just 1.3% of the time. Now remember, you need 7 to 10% of the time to break even. The type of day that we saw yesterday only happens 1.3% of the time.
Oh man.
So you need 7 to 10. It only happens 1.3. So here you can see on any random day, on any random day for the SPX to close down by 1%, by 1.5%, or by 2%, obviously the numbers below that, 13.5, 8, and 4.5. But when the VIX is below 15, it's only 4.8, 1.3, and 0.4. So we had that 1.3, which is the VIX. I'm sorry, the SPX yesterday closed down. About 1.5%, which is where we get that 1.3 number. Crazy. Okay, let's go to the next slide. So if you're playing for at least a 1% down move in the SPX, you'll need, now that's just a 1% down move. Right? Like right now, today, we don't even have a 1% down move. But if you're playing,
I mean, you got it in the Russell, but you don't have it in even the S&Ps. You're down 0.5%, a little bit more, 0.5%.
Right, but if you're playing for a 1% down move in the SPX, you'll need at least 21 times return on the long 0 DT puts to break even over time. So yesterday, we saw that most of the puts of those out-of-the-money puts were up only 15 times at most. So even yesterday with a 1.5% move, you didn't even get close to the 21 times return you need to break even. That's why I never understood those guys, Tony, when they would talk about this is the way to play for the outlier moves. Even a day like yesterday didn't even get you back to even. So look at these numbers up here. If you have a 1%, if we close down by 1%, the probability of seeing that move when the VIX is below 15 is 4.8%. But the profit multiple required to be long those cheap puts to break even is 21 times. Yesterday, to hope for the 1.5% down move we had yesterday, which happens 1.3% of the time, even though you need it between 7 and 10% of the time, you would need a 77 times return on those puts to break even.
Wow.
Now, what this tells us is that
you can't do it. It's just not. It's not.
Not only can you not do it, I don't even believe that other than if your timing is like, unless you.
Yeah, you gotta get purely lucky.
I remember there was before the 1987 crash. I don't remember the kid's name, but there was a kid trading in the OEX pit, and he bought a ton of puts the day before the crash, just blind luck, okay? And he made a lot of money. And everybody said, oh, man, that kid's a genius. But I bought a lot of puts on a lot of days, and I never made any money on them.
Of course. I mean, you remember the story of the trader who thought he was buying, 100 puts or 1,000 puts. He ended up buying 10,000 puts. I mean, it was an out trade. It was a mistake, but it worked out. I mean, that's you got to get lucky. The way you can do this is get lucky.
I love telling the story of one of my best trades ever when I was forced. I was trying to buy puts, and the broker, the order the broker had was to sell like 2 puts and 1 call. Like it was a combination, and so I had he stuck me with the calls, and it was late in the day, so I wanted the puts. I got them, but I didn't want the calls, and I couldn't sell them to anybody because nobody would buy them for me because it was too late in the day. So I was stuck with the calls. The next morning we opened up limit, and the calls made all the money, and the puts were worthless. Right. And I hated that trade. I was pissed all afternoon and all night about that trade, that he stuck me with the calls. Like, that's just the nature of this freaking business. It's crazy.
Sure.
Let's go to the last slide. So with such low probabilities of seeing a large down move in the SPX when IV is low, those trying to time a 1% plus down move need to make at least 21 times on those moves that they're correct on to make up for the majority of the days that are losers. So with such moves being few and far between, even if you do get a large move, holding onto a long option to make it 21 times X is unrealistic in all cases. Now, if you want to do it on a one-off basis, go for it.
Sure.
It's cool, no problem. But just don't make it into that's your game plan.
It's like any other directional trade.
Yeah, it can't be your game plan. On a one-off basis, go for it.
Awesome. Let's take a quick 90-second break and come back. I should have said any other 50-50 shot you want to take in the market. Let's take a quick 90-second break and come back. We got more Tasty Live coming up next with, oh joy, your friend and mine, Mr. Scott Sheridan, Tasty Trade World Headquarters.